In this video we will analyze Warren Buffett's biggest investment mistakes, including a macabre story that few people know, and that is linked to his biggest investment mistake, which almost cost him his life. Warren Buffett is one of the best investors in history, having been able to generate an annual return of 20% since he became CEO of Berkshire Hathaway in 1965. This return compared to the S&P 500 over the same period was only 10% per year. If you had invested $10,000 in Berkshire Hathaway when Buffett became CEO, you would now have over $271 million. If instead of trusting Buffett you had invested in an S&P 500 ETF, you would have just over $2 million today, which is not bad, but a far cry from the staggering long-term return Buffett has generated for his shareholders. Even so, not everything has been a bed of roses for Buffett and his investors, so I find it very interesting to analyze the biggest investment mistakes that Warren Buffett made throughout his career. It is also a good way for us to improve as investors. In addition, we will see which of these mistakes almost cost him his life. First of all, and surprisingly enough, one of Warren Buffett's biggest investment mistakes was to buy Berkshire Hathaway. This company was actually engaged in textile production, so it operated in an extremely competitive industry. Buffett started buying Berkshire shares in 1962, however, he was not happy with the management of the board, so he bought more shares until he managed to take over the majority of the company's shares. This led to the board of directors firing its CEO and appointing the CEO of Berkshire Hathaway. Over the next few years Buffett invested in new machines that in theory would reduce production costs, and this in turn would improve the profit margins and EPS generated by the company. But the harsh reality was that Berkshire could not compete with rivals with much lower labor costs such as the Chinese companies. Buffett kept Berkshire's operations running until 1985, when it became Buffett's holding company, that is, the company from which he invests in other companies. The lesson to be learned from this mistake is that it is very important to buy businesses with clear competitive advantages, and that these should be long-lasting, as Berkshire lacked any kind of competitive advantage that would allow it to protect its profit margins and ROI, so in our profitability going forward it was more than doomed in advance. The next mistake I want to tell you about is Kraft Heinz. Kraft bought the food giant in 2013 in a deal valued at over $28 billion. Buffett financed much of this purchase and allowed him to take 26% of Kraft Heinz in 2013. Kraft justified the $28 billion they wanted to pay for Heinz by arguing that they could generate great synergies, mainly a reduction in operating costs thanks to sharing certain central costs such as the management of ingredient purchases, which is what is known as synergies. Kraft claimed that the buyout would significantly increase the company's EPS in the years to come. To achieve this growth, Kraft's board established a series of objectives for Heinz managers. The problem was that the objectives they imposed on Heinz managers were practically impossible to achieve, so Heinz managers decided to manipulate the accounting of the business between 2015 and 2018 to deceive Kraft Heinz's board, making them believe that people had generated an EPS higher than the real one. This accounting scandal came to light in early 2019, which was precisely when the Kraft Heinz board discovered that Heinz's accounting had been manipulated. This deception meant that Kraft Heinz's actual EPS had been lower than what the company had reported since the Heinz purchase. Furthermore, this lower EPS implied that Kraft had paid an exorbitant price to acquire Heinz. That is, they had paid a very high multiple for this business, and the return on investment in Heinz would be much worse than what the board had announced in 2013. Proof of this is that the annual return of the company since the Heinz purchase was completed has been -11% per year, a real disaster for Warren Buffett, but this was not the mistake that almost cost him his life. As a lesson, in this case we should learn that it is very important not to pay high multiples for a company, even if it is one of the largest stable consumer companies in the world. In the last few months we have lived through a time when many companies have been heavily overvalued and in just a few weeks have suffered drops of 50%. History is always doomed to repeat itself for those who do not learn from it. Buffett's next investment mistake was in 2016 when he bought a package of airline stocks including American choices Delta, United, American and Southwest. Buffett's investment thesis was that the industry was in consolidation and that with fewer rivals they would not compete as much on price, and this would help airline operating margins and EPS to increase. But this scenario did not happen, and the airlines were still competing fiercely with low fares to steal market share from their rivals, so Buffett decided to sell all his airlines. Moreover, he chose the wrong time to sell these companies, as they were sold between March and May 2020, just after the impact of the pandemic. Interestingly, this was not the first time Buffett had made a mistake when investing in airlines. Buffett deeply regrets investing in an airline that was called US Air in 1989, as it was on the verge of bankruptcy for the next few years. Fortunately for Buffett, this bankruptcy scenario did not happen, but he admitted that it was one of his biggest investment mistakes. Undoubtedly, this mistake when investing in airlines reminds us once again that as investors we must invest in businesses with strong competitive advantages, otherwise the chances of success are greatly reduced. Another big mistake, but also not the one that practically cost Buffett his life, was to invest in the company Precision Castparts, also in 2016. This company is dedicated to the supply of components for the manufacture of aircraft, such as commercial airplanes or jets. In 2021, Buffett admitted that he had been too optimistic estimating the future profit growth of this company. Buffett paid over $37 billion for this acquisition, but in 2020 Berkshire Hathaway was forced to book an impairment of $11 billion on this acquisition, i.e. the company was actually worth $26 billion, 30% less than what Buffett had paid for it just 4 years earlier. Remember that in investing it is very important to be very conservative when estimating the future growth of a company, because if we are too optimistic, this could lead us to make a bad purchase decision, which would cause our annual return to be unsatisfactory or even negative, as happened to Buffett with Precision Castparts. And fifth and last, we have Warren Buffett's biggest investment mistake during his entire career. This mistake made Buffett himself fear for his life according to some of his closest people for the reasons I will explain below. The investment in question was Salomon Brothers, where Buffett bought a majority stake in this US bank in 1987 valued at $700 million. Although today this amount may not seem like a lot for Berkshire Hathaway, it was actually Buffett's largest outlay in a single company up to that time. What happened with Salomon Brothers is that the bank broke the Federal Reserve's rules when buying treasury bonds, and this led to the Federal Reserve notifying Salomon Brothers management on August 18, 1991, that they could no longer buy US Treasury bonds. This effectively bankrupted Salomon Brothers because banks mainly make money by borrowing from the Treasury and then offering it to companies or individuals. For example, a bank can borrow from the Federal Reserve at 1.5% and then offer the same money to companies or customers at 6% per annum, so the real profit is based on this difference or spread between 6% minus 1.5%. In other words, the bank would earn 4.5% on this operation. If the bank could no longer buy US Treasury debt, it would not be able to offer new loans or mortgages, so most of its business would disappear and it would not be able to meet all the operating costs represented by its network of offices and thousands of employees nationwide. When Warren Buffett learned of this ban on the purchase of US bonds, he personally contacted the Federal Reserve to ask them to cancel this measure, as it would have disastrous consequences for both the bank and the US economy. Buffett succeeded in influencing the Federal Reserve to overturn the ban just 4 hours after it occurred. But this was not the end of the story, as Buffett himself was forced to take over as CEO of Salomon Brothers after the resignation of the bank's previous CEO John Gutfreund, meaning that Buffett became the company's top manager in the most turbulent year in the bank's history. Overnight, Buffett found himself embroiled in dozens of investigations into the numerous irregularities committed by the bank, while Buffett was CEO of Salomon Brothers, facing a possible jail sentence, and all this while the bank stock plummeted. This possible jail sentence, for which Buffett was absolutely not at fault, coupled with the enormous and constant threats from his shareholders, was probably the most difficult moment in his history and almost cost him his life. In fact, Warren Buffett had to appear in September 1991 before the Chamber of Commerce in Washington to explain the malpractices and illegalities committed by certain employees and executives of Salomon Brothers. Fortunately, Buffett managed to clear everything up, and the investigation resulted in a $190 million fine for the bank and a sanction for the former CEO of the bank, John Gutfreund, who could not run any other bank for the rest of his life. The most important lesson we can learn from Buffett's big mistake is that banks are like black boxes and we never know how the business and management is really run. One way to avoid this type of investment mistake is to look for companies that are run by honest and upright management teams, and to do this, we must act as investigators and try to find information about the CEO and management. In this way we will see if any member of their team, in any other of the companies they may have managed, has been previously fined for bad practices. My advice is that it is better to err on the side of conservatism in these types of companies.